my neighbour or my colleague, my co-worker, told me that the market's going to drop further next week. Explain to me how they might know what that's about.
Probably right. So this gets into the whole concept that we talk about of what's foreseeable, what's predictable, and then ultimately what's actionable, and what's the risk of that action. So could I foresee the market dropping next week? Absolutely. Like, there's never been a day in history where I couldn't foresee that. And I could give you great reasons. It's why when you look at the finance news at night or whatever, you'll see, whatever talking head expert there is, there's always a reason why the market went up, down, sideways, whatever it is. There's some news today that did this. In fact, one of the things I encourage people to do is read newspapers or news reports a week old. So if you read the paper from a week ago and then see how much of that news is still relevant to you, it gives you a very different perspective on just how urgent and important that was. But if you think about that just from a mechanical point of view, right? So let's say that the market's going to crash on Wednesday, right? Well, the smart money gets out on Tuesday, doesn't it? Doesn't the smart money go, well, what am I waiting for? Don't ride it to the end, right? Let's just get out on Tuesday.
Yep.
But the super smart money knows that, right? So Monday afternoon, it's out, right? But the inside money knows that the super smart money is getting out on Monday. So why are they taking the risk? So they got out on Friday, right? And then the hedge funds or whoever's in front of those people got out on Thursday. So everyone got out yesterday, in other words. And not only the get out scenario it's a really important thing to understand in market. So if you look at a market, look at a share price, a trade, this is again, I'll use CBA, was trading at say $60. That means someone sold it for $60, which also means someone bought it. So there's this idea of investors fled the market or people got out. No, shares traded hands, right? So if investors truly got out of the market, then there wasn't a trade. Right. So investors,
no one's buying.
Someone bought it, right? So otherwise there wasn't a trade. Otherwise it'd be like there's no volume today. Now, the volume might have been whatever it was, and the share price moved to whatever the balance of buyers and sells were. But if there was a price today of a stock, then there was a trade. And if there was a trade, then the same number of sellers was matched by the same number of buyers. So there's no such thing as getting out of the market. It's just who paid what price. It's a bit like saying, David Jones had a winter sale today where it was 70% off coats, right? And so, I don't know, coat people got out of the market today. It's like, no, I got a bargain on my winter coat. That's what happened.